In this video, traders are going to look at what are zombie stocks. Stay tuned. Hey guys, warm welcome to you. Alright, so you might have heard this phrase before. This phrase came out probably 5 or 6 years ago, if not longer, when a lot of banks were just struggling. They were alive, but they were kind of just floating along. And that's where this name zombie comes from. In other words, you know what a zombie is. It's the undead. It's kind of that limbo between being alive and being dead. And this is what companies potentially sit in. And they're called them zombie companies or zombie stocks. So what qualifies as a zombie company? Well, there's a kind of few definitions out there, and it depends on who you listen to and kind of where you get your information from. But theoretically, if you think that the overall kind of definition is a company that's not bankrupt, but it's not really thriving, then there's a few things that fit in there. But for me, it's this. It's number one, it's they're just covering the bills, i.e. the rent, the payroll, utilities, all the other stuff they've got. And the important thing is the debt. This is the key part of the zombie kind of stock phenomenon, is they're covering the interest payments on the debt, but they're not paying down the debt. So they're literally just sitting there spinning their wheels. They can't borrow more to invest more to grow. They can't pay down the debt to then get more on the balance sheet and then invest and grow. They're just sitting there. They're okay. They've got a viable business, so to speak. In other words, they aren't dead yet, but they are very, very vulnerable. They're very vulnerable. That's what we put number two here. They're literally 1 quarter away potentially from bankruptcy or one catastrophe away. They haven't got the funds to weather any storm. They are just sitting there chugging along. If the bank can't pull the debt because the debt is being paid, so the bank's happy that the interest is at least being paid. In fact, the bank's the one or whoever's loaning the money is the one who's making the most money out of these zombie stocks because they're getting the interest payment. All the companies there existing to do is to pay off the interest. But they won't lend them any more money because they recognise the position they're in, so they can't borrow any more money. And a couple of interest rate hikes away from being out of the game. And we've seen this before with other companies, specifically banks on the other end of the deal, where they've literally not been making any money and they're so vulnerable to not specifically an interest rate rise, but any slight kind of tightening around their business model just sends them into catastrophe. And this is why the thing about zombie stocks, guys, is kind of, let's go off track a little bit here, or zombie companies, is the bigger companies. They're normally companies like over 10 years old. We're not talking about new companies that are just getting started, just getting traction. We're talking about companies that are over 10 years old. They're probably over 500 million market cap, that kind of thing. And there are a lot of these companies now, and they're rising. And there's studies that say that we're talking about 10, 12% perhaps of the companies out there. The trouble with these is that these are all employing people. They're big companies. They're servicing debt. They've got a lot of kind of money flowing through the system, if you like. They're producing a lot of jobs. They're producing whatever it may be, whether they're manufacturing some goods or whatever the business model is. And the trouble is they have to really keep going, because if all these zombie stocks or zombie companies just folded, imagine the fallout in terms of just from employment. So this is a big issue for countries. They kind of say, well, we kind of have to keep these going. This is why we have the bailouts and stuff, and we'll have to go down that in that video. But that's ultimately why some of these bigger companies get these lifelines, because it will be worse for them to be out of business than it is just for them to be limping along. So we've got these zombie stocks. They're just about covering their debt, just about covering their bills, very, very close to bankruptcy. They can't invest in growth. From our perspective as traders, there's risk and there's opportunity here. So if you can identify companies that have this kind of phenomenon, i.e. they're just plowing all their money back in and they just seem like they're going nowhere, and you can find a potential lifeline, then maybe there's an opportunity for significant growth. Now, what is that? I don't know. That's going to be dependent on the company, but also risk. Because you've got the risk, most likely these companies are going to be trading at a serious discount. The chart's going to be one-way street for the past 5 years, because nobody really wants them, because they're not going anywhere, they're not providing any growth. Maybe they're providing a dividend, but the risk is not really offset by the risk of these guys going bankrupt. So they're probably going to be hammered. The chart's going to be absolutely hammered. Although there are some exceptions, slight exceptions. Let's digress slightly. When you think of some of the, I say newer companies, have been around a while, but like Netflix, Tesla, for example, they're kind of growing and they've got the potential for growth. They're a little bit different to ones like these kind of big ones like GE, Sprint, GoDaddy, Hertz. Those are just some examples. I've not dug into the actual numbers. Those are some examples that I found from other articles online, done some research, but you kind of make sense, right? Big companies have been going a long, long time. So risk, but there's opportunity, because if you can spot a potential kind of lifeline, if you like, that all it needs is a catalyst, that whether it is a reduction in debt, whether it is some sort of external investment, whether it is some sort of cost cutting, something that can just trigger the growth cycle again, then from a trader's perspective, you know, that stock then could give a serious lift as it starts to come on the radar of the funds, the institutions, all that kind of stuff. Now, to say these aren't already, they're not in portfolios, but they're not considered kind of good growth stocks that you'd see good returns from and people piling into, because they're kind of stuck in the zombie state. But if you can find the opportunity, and if you can dig into these, get your list out, start to dig in and say, where potentially could the opportunity come? And there's probably going to be, you're going to find 1 out of 50 that maybe is there. And that could give you a potential decent lift in price in the stock. But of course, bearing in mind, there is risk here. Economy takes a downturn, debt gets tightened up, credit gets tightened up, all those kind of stuff. These guys are the most vulnerable. So maybe there's an opportunity from the short side as well. Anyway, guys, that is zombie stocks. Thumbs up if you like my zombie drawing, and I hope that's helped you. Take care. Bye-bye.